Hello, my name is Manuel Kuzai. I'll be your host for today. Welcome to episode 1 officially of The Property Expert. Today we're going to be concentrating on property valuation. 6 main topics, which are: what is real property? Value in relation to real property. Who values real property? Why value real property? What determines real property value? What methods are used to value real property? So what is real property? So real property, we're going to refer to it as the land and the permanent improvements on the land. So that those things are integral to form part of the property, the real property that we're going to be referring to. So it's things that above the air all the way to the minerals below. Permanent and structures on the land include all buildings and physical structures, movable items that have been attached to the land, structures, equipment with an intention of being placed there permanently on the property. Also referred to the trees and the growing crops. And that all forms a part of real property, because now you cannot sell the land alone without the structures. The building on the property constitute that piece of land to become a real property with all the improvement and the physical structure attached to the property with the intention of keeping it permanently. So that's how we would define real property. An example of real property would be like a painter when you would paint on a canvas. When you sell the picture, you sell the picture with the canvas. So you can't sell either without the other. So that's how you would look at property when you go into that space. So always have that idea in mind. So real property can be classified in different categories. We've got residential properties. Residential properties would refer to homes that you live in, like for family usage, or maybe to accommodate people. Could be student accommodation, reses. Those can be regarded as residential property. We have commercial properties. Commercial properties, you're going to be referring to things like malls or buildings, like office buildings. Those can be referred to as commercial property. We've got industrial properties. Industrial properties, it's more of your warehouses. You get light industry and heavy industry, so it's going to be warehouses, factory. Those are considered as industrial property. And then we have agricultural property. Agricultural property would be farming. Those are the kind of activities you'd find. Then you would get special properties. So special properties refer to places of worship like churches, recreational spaces, museums. Those would be items or properties that would be referred to as special properties. Value in relation to real property. So value means different things to different people. For example, this t-shirt I'm wearing today, it got higher value compared to all the other clothes in my wardrobe. For the mere fact that I wore it today, it means I placed a higher value on this item. Not saying that any other of my t-shirts don't have the same value. However, today, this t-shirt right now holds the most value for me. That's why I chose this t-shirt. So also within property, there's various kinds of values that go into it, and these are some of the values you would find in property. So one of the values we can look at is value in use. So value in use refers to a property in current use, which depicts the usefulness of a given property to satisfy human need. So not necessarily does it need to be attractive to other buyers. That's what you find in value in use. Value in exchange. Another value we can look at is the amount of money that exchanged when the property was sold. That is recorded to value in exchange. Another amount which is known as fair value. So fair value would mean fair market value at the date of valuation. So if you have a property valuer that would come out to your property and value your property, the value that they would receive on that date, on the date of valuation, that amount is referred to as fair value. So in 6 months from now or a year from now, that can change. However, fair value refers to the value achieved at the date of valuation. Objective value, the value I started with when I started the show, it's more on special significance. How special is this property to you? The same way how special was this t-shirt to me? So that is subjective value. Investment value would refer to a value of a property to a particular investor. So when people go into property investment, there's certain returns that they're looking at achieving, and once they can get that return on that property or that yield amount, so maybe in simple terms, if you buy a property that you want to eventually rent out, if that property can give you 1,000 rand per month and that's the amount you'd want to achieve, that is the investment value that you would have as an investor. Another value that we're going to look at is called capitalized value. So this is based on the net income flows discounted to the present value as viewed by the investor. So let me try and break it down a bit. So when you have a property and you're generating money from it, let's say you have a mini shopping complex. Per month you make 20 rand from it, and then your operating cost will be 10 rand. So your net income will be the 10 rand, which will be referred to as profit. So we discount it to the present value. So let's say that 10 rand per year escalates every year, maybe for the next 4 to 5 years, depending on the type of leases, and you do a projection. You anticipate that in year 1 you're gonna get 10 rand, in year 2 you're gonna get 11 rand, in year 3 you're gonna get 13 rand. So what you do, you discount that amount by percentage to the present value. Which will give you a value today. If you were to buy this property now, and then you would project that you would get incomes as explained of net income flows, and then you bring it to today's time, then you'll be able to see the value that the property will have. So that's what investors would view as capitalized value. So now, who values real property? So in South Africa, next value we're going to look at is market value. So I'm gonna read out the definition. It says, market value is the amount a willing and knowledgeable buyer would likely pay a willing and knowledgeable seller in the open market at the date of valuation. So from that definition, the few areas that we need to look at are the willing and knowledgeable buyer and seller, and the open market. So I can just explain some of the stuff, some of the information to you. So we're going to start with the willing and knowledgeable buyer and seller. So one, they must be able to buy or sell. So the seller must be in a position whereby they actually want to get rid of the property. They're not be tight with money or can no longer afford to stay in the property. So they actually are in a position that they want to sell the property, and the buyer should be able to actually afford the property. Part of the willingness is the consent from each party that the buyer would like to actually buy the property and is not forced under duress to do so, and vice versa with the other party. The buyer and seller really need to be objective when they're dealing with these properties. So the seller should not have any personal attachment to the property or impersonal bargaining that will go into this transaction, and that the seller and the buyer have enough knowledge of the type of stock or the type of properties that are out there in the market. So for example, if you have a 3-bedroom house that you want to sell, or the buyer wants to buy, they must be aware within that area probably there's like 4 or 5 other 3-bedroom house properties in the market that can also be sold or bought. So, and there's knowledge of what is the going rate around it. So that is the one thing that one should look at. And then another issue would be the willingness. Part of it is the price, the actual price of the property, because sometimes you'd find that neither party wants to budge on the price. So as long as there's room for negotiation and none of the parties are stubborn, that would be recorded as a willing and knowledgeable buyer. And then the next part of that definition, which is very key, is the open market. So when we refer to the open market, we refer to information about recent sales in the area that are available. So all the properties that sold within the 6 months period, similar properties, and also you must have knowledge of that similar properties to the property that you are buying or selling. Information that is needed, information about the sales in that area in its entirety, even though the properties is not identical or similar to the property being sold, but have an overall feel of what the area is going for. Is it a market that is increasing in value? Is there a high sales transaction within the area? An open market would also be, is the property widely advertised? So sometimes we refer to widely advertised. You take means to put out your property in the media, for example the internet, to try and sell your property. Is your property available for people to come view? Do people know about that you are selling your property? Because now when it's not an open market is when the information is very limited to the number of people that know that their property is for sale. So that would refer to as an open market, not like a private sale, because also a private sale will be considered as an open market. And also knowing who are the buyers in the market. People are able to access that property. So that would be referring to the open market. So those are some of the values that one could look at into real property. Deal with who values real property. A person that is licensed to value property is a property valuer. And a function of a valuer is not to create value, but use a logical process to arrive at an estimated market value. That includes three main things. One, a description of the property under consideration. The valuer's opinion of the condition of the property, like when they go and see the condition of the property. And number three, its probable monetary value in the open market. The valuer would normally take the following steps to determine value. Determine the type of property and the purpose of valuation. Is it a commercial property? Is it a residential property? Why value real property? So the next topic is why value real property. So a valuer can be called upon to provide an estimate of real property for several reasons. Some of the reasons we're going to look at is market rent or market value for renting. If you have a property and you just want to figure out how much can you charge your tenants, a property valuer can be used for that, to determine what could be the market rent you could charge your tenants. Is the market value for rating by the local authority. So it could be your local municipality. That's what they charge you on rates and taxes. That's where they would get it from. Also value property for asset value, for bookkeeping, corporate reporting. That's also another reason why you value property. Another one would be for market value for mortgage bond or financing. When you want to buy a property, a bank would call out a valuer to go see whether the property you want to buy is worth the amount that you borrowing the money from the bank in terms of a loan. and should you probably forfeit and not afford the property anymore, the bank can also still sell the property and recover the money that they borrowed you. So that's some of the reasons why there would be a reason to value a property. Another one would be market value for expropriation of land under the Expropriation Act. So expropriation is a process whereby the government would come to you and say, we want a portion of your property or the entire property, and then you basically have to sell it to them with compensation. However, now there's discussions in the country of whether or not to relinquish that property without the state paying compensation for your property. So that is still ongoing. We're going to look into expropriation, one of the new topics. Another one for market value for restitution under the Restitution of the Land Rights Act. Another one, land restitution, giving the rightful owners the land back, which have been because of apartheid and past political injustices that happened in the country, to determine the value so they can give people back the land that used to belong to them. Another reason why you would value property for replacement costs for insurance purposes. So when you take an insurance cover on your property, the insurance company would like to know how much they would actually spend in replacing the costs of your property, or things if they could be damaged by fire or any other causes. Valuation for arbitration in settling disputes. So this could be divorce cases or liquidation. So in a divorce settlements, you're married with your wife, you have a community in property agreement. By now the property has to be sold. So a valuer will come in and determine the property so you can do your splits in a divorce situation. Or through liquidation. Liquidation refers to when maybe company A used to own property, now the company is no longer successful and is going under, as in debt. So a process whereby banks and all the people that the company owes would want their money back, then they'll go through a liquidation process. So now a valuer would value the immovable property or the real property that can be sold by the liquidator to the different beneficiaries that the company owes that is now defunct. The valuation for limited rights or servitudes. So these could be right of way over power lines. For example, I think when you've noticed a power line that will go across a farm or your house, or maybe if there's a pathway that the government has decided to use within your property, that will be regarded as a servitude. That is normally registered in the title deed, whereby there's a right of way over your property. So those are some of the reasons why we would value real property. What determines real property value? For real property to have value, it must satisfy 4 elements referred to as an acronym called DUST, which means demand, utility, supply, and transferability. So when we say the D is for dust, it must have demand. There must be people who are actively looking for their property and willing to pay that amount for their property. It must have utility. It can serve a useful purpose. For some, it could be permanent residency. For others, it could be a second home, a vacation home, and they'd want to use that space as more of a space that they can relax in. And third, it must have scarcity. So it should be short in supply. When there's oversupply, it does not really have too much value. And then the last one would be transferability. It must be a tradable commodity that can move from one from one land to another. So it must be tradable in that respect. So in understanding dust, there are characteristics that one needs to look into, which are location, physical characteristics, institutional characteristics, and economic characteristics, because all these characteristics have an impact in a property having value. So we will look at characteristics like location first. For example, supply takes time to arrive because of things like rezoning. Rezoning takes time, so that will delay the process of new properties being built. So now rezoning would be a space whereby we want to convert an agricultural property into zoning for residential, so we can start to build homes in that area. So that process normally takes time. Normally it takes about 2 years time frame, give or take. So that would affect supply in a particular area. So that's how location is affected. Next part would be exposure to the land use environment. Is the area mostly residential, or is the area mostly hotels? Then you also look at exposure to the climate conditions. Is it a hot area? Is it a dry area? For example, Limpopo would be regarded as a very hot area where avocados can grow well. And you look at a place like by the coast, like Western Cape, where you'd find the area is very rich in harvesting things like grapes for wine. So those are some of the climate conditions we look into. Then another part is the exposure to psychological and socio-economic environment. So like the social status, is the area class area, mostly middle class people live there or low class people live there. So location does factor into a lot. And then another one which is not always looked into is exposure to sensory environment. So that would refer to views, smell, noise, that kind of thing. Then another factor would be physical characteristics. So physical characteristics would include the size and shape of the land. And then another one would be geological conditions, bearing capacity of the site. Like, is it gradient, is it on a slope, is it a level of service, is it in a mountainous area? Then we look at infrastructure and services available. Are there roads, tarred roads in the area? Is there electricity supply? So those are some of the infrastructures we're looking at. And then the building itself. So another physical characteristic would be the building, the aesthetic appeal, the durability of the material used. Those are some of the things we look at. Functional obsolescence. Is the area that was formerly known as an industrial area, now that whole industrial area has died and now people are moving to another area. So the function or why that area developed was because of that industrial hype that was there or activity that was in the area that has now died out. So another of the factors is institutional characteristics. So this would include property rights in a form of ownership and servitudes, mining rights, leases, things that one has to look at. Then there's government control measures. That would do mostly with physical planning laws and building codes aimed at orderly and audit tax, particularly from the local authority rating. That would be like your local municipality. And then another part within institutional characteristics is the right of eminent domain. So expropriation possibilities. If the area that you want to move to or that you're in is an area which has a lot of expropriation cases, there's that possibility that your property or the property that you might want to invest in could have a possibility of also being expropriated. And the last factor in determining value in terms of characteristics would be your economic characteristics. So general economic conditions, the construction industry happening. Is there a lot of construction happening? Is there no construction happening? Is the construction prices increase or decrease? The unemployment rates within the area. So those are general economic conditions that we look into. One would be fiscal and monetary policies. So that would be your interest rates. Like right now, South Africa is facing a period where we have very low interest rates. That means when you borrow capital, maybe as a mortgage or any kind of financing, you're gonna pay pretty low repayment fees on your loan due to the low interest rate that we're currently having. So those are some of the monetary policies that affect economic conditions. Then you will have the population growth. So population growth is a key one, whereby population growth could be population growth within an area. So that would do with urbanization and migration, people moving from one area to maybe a more popular area with more opportunities. Population growth in terms of birth rates and death rates, those are some of the things that you look at. More people moving into or residing within that area contributes to a lot of economic growth within the area. And then lastly, we look at the wages and incomes. So that would be the income levels of people that live in the area, how much they can afford to spend per capita in terms of the household, how much money per household do they have. Those are some of the income levels that we look at in a more of an economic condition type of characteristics. So it's part of the factors of what determines real property values, which is a very interesting dynamic, especially when you start to understand dust and the characteristics of it. Remember, dust is demand, utility, scarcity, and transferability, and then from that you understand the characteristics of those elements, which are location, physical characteristic, institutional characteristics, and economic characteristics. Should lead you in a good light to understand what determines value in a property. What methods are used to value real property? Methods of valuations. So the one key important thing is to remember that valuation presents the valuer's opinion of the property's probable monetary value upon the open market. So that means in deriving an estimate value, the valuer uses a number of valuation methods. Most important being the three main ones, which is sales comparisons method, the income capitalization method, and the cost method. So how it happens is that methods will be used will be determined by the type of property being valued. For example, if it's a church, because it's not something that generates income, it will require a different method to be used compared to maybe a residential, or maybe we could look at something like a cost method for churches. And the purpose of valuation is another determinant of the type of method used. So we look at something like the valuation method used for insurance will be different from a method used for investment purposes, whereby insurance is mostly concentrating on the replacement cost of damaged items, whereby investment purpose will be how much can be derived from this property and what returns can be obtained. And then lastly, the information available. So for example, in areas where property is isolated or in remote areas, those properties become tricky because market data is really available. So those sales transactions will determine what type of methods to use when it comes to valuation methods. The method we're going to look at is the sales comparisons method. This method is based on the principle that, for example, someone will be willing to pay a particular amount for a property influenced by the cost of acquiring a substitute or comparable property. So what it means that the valuer therefore has to compare the subject property to similar ones that have been recently sold in the neighborhood. They look at a few factors. For example, they would select comparable properties available in the market, at least 3 in comparisons. They would select characteristics that influence people to pay different prices for this type of property. So we would talk about things like the bedrooms, the number of bedrooms, bathrooms, kitchen, finishes. Those are the kind of things that new owners or new homeowners or people that buy property will be looking at. Another one is, the next step is to identify the differences between the subject property and the sales comparables. So from the 3 properties, for example, that the valuer will pick, they'll start to identify the differences, if whether the comparable properties are inferior or superior in quality towards the subject property, or they're quite similar. And what the valuer must do is to make adjustments to what he sees. For example, if the properties in the market are superior than the subject property, he needs to adjust the amount by decreasing or increasing to compensate for lack of, or maybe if the subject property has got certain things that are in par or inferior to the comparable properties in the market, according adjustments has to be made by the valuer. We're going to go deeper into the calculations of comparable sales method in our another video, where we go in depth with the different methods and how we do adjustments. So after going through the process of each comparable property, then the value adjusts using a mean to arrive to the value of the subject property. The next method we're going to look at is the income capitalization method. So also fairly straightforward, uses mostly numbers in this one. So what you have your potential gross income from the property. So it could be rental, if you have an office block or apartments. And then you would also have your expenses, so upkeep and management of the property. So what you do, you would minus the income from expenses, then you get your net operating income. From the net operating income, the another part you're gonna need to get is your capitalization rate. So your capitalization rate is normally the expected return or the yield from the investment, which may be based on the opportunity, cost of money, or comparable returns of similar properties within the area. And that's how you get your percentage rate for capitalization rate. And then how you would calculate now the value of the property is that you would take your net operating income divided by the cap rate. That will give you the value of the property. The next method we're going to be looking at is the cost method. In the cost method, the valuer estimates the value of improvements to the land, whether old or new, then adds the value of the site. So for example, the first part would be value of improvements will be based on 1, reproduction costs if it's a new property, or replacement costs. So replacement costs will be reproduction costs minus depreciation if it's an old building. Then the last part would be the value of the land will be based on sales comparisons method, using recent sales of vacant land within the area or vicinity. So that's how you would go about with your cost method. So to wrap it up, it is basically your reproduction cost or replacement cost of improvements plus the site value, which you will be getting from your comparable sales of vacant land, will equal the value of the property. And that's how you determine the value of the property using these 3 various methods. Last topic, we looked at the sales comparisons method, the income capitalization method, and the cost method. These are the three methods mostly used by valuers when they would want to come to an opinion value of your property. So I hope this gave you enough insight in terms of what really goes on into property valuation. The beautiful thing is our channel will go in depth with the various topics and the things we discussed today. I have shows specifically focused on each valuation method. What does dust mean going into supply and demand, highest and best use, and really unpacking the property industry. I hope you're going to enjoy more of our shows. Make sure you subscribe to our channel, and thank you for joining us. It's been a pleasure. If you have any questions that you'd like to ask us, just post it on the comments. We'll give you an answer for that. Whatever property questions you might have, we are here to assist you. Thank you for watching. Have yourself a good day. Bye.